Hello and welcome to Buy Africa, the show where we focus on investment opportunities around the continent. I'm your host, Tshepo Modiba, and thanks for joining us. Tonight my guest is Usoro Essien, Head of Research at Greenwich Trust, and he's joining us from the Lagos studios. Usoro, thank you for joining us once again. I thought it's quite interesting to delve into specifically the banking sector right now. We know that broadly speaking, banking is a leverage on the underlying economic performance of any country. Your thoughts on the sector right now? How are the banks in Nigeria holding up?
Last year, 2014, the sector as a whole trailed the index. The index lost about 16%, whereas the banking sector index lost about 33% for the full year 2014. Only 3 banks actually closed on the positive, and these were Stanbic, ETI, and Sterling Bank.
Yep.
The sector had a lot of regulatory pressure. The CBN was faced with declining revenue from the Federation account, and also FX pressures. So there was a lot of tightening measures from the CRR, and also the eventual hike and the fourth quarter of the MPR. So for banks, their core business was stifled more or less, right. And you saw as far back as Q3 and Q4 last year and Q1 this year, a lot of income coming from the non-core businesses, the other operating income lines. Yeah.
In terms of, I guess, the underlying regulation changes, it meant that a few of the banks had to increase their capital base and raise quite a bit of capital, and naturally that doesn't bode well for growth in the short term anyway.
Yeah, very true. You had nothing less than 6 lenders going into to raise capital, both tier 1 and tier 2, because apart from the SIB classification, which is the classification of systematically important banks, which were the top 8, where key regulatory ratios like the CRR and liquidity ratios were slightly higher than your other banks. They also came out with a new calculation of total qualifying capital. So you could not just rely on tier 2 capital to shore up your total qualifying capital. They pegged tier 2 capital at 33.25. So you could only raise so much of tier 2. Remember that a lot of banks, even before last year, entered the Eurobond market to get cheaper long-term debt. This had to now be used for on-lending into facilities with maybe dollar-denominated facilities. Tier 1 capital had to be raised, and it was difficult doing that in a bearish market. You saw the incidents where banks had to either move forward or move back their capital raising plans. Yeah, 2004.
I guess the recent energy crisis, would that have had a material impact on the bank, or did it last short enough that really from an underlying operations perspective it wouldn't have had much of an impact?
It had a negative impact in the sense that declining crude oil prices, because of how our economy is, directly affects FX.
Right.
However, because the banks are very savvy, you could see a huge chunk of their operating income come from that volatility that was caused in the FX. Hence, a lot of banks posted good numbers from FX translation gains. So one-off activity that happened in the past 9 months actually benefited most of these banks that were poised properly to report strong earnings from FX translation gains. Yeah.
Okay. If we can delve into 2 of the banks in particular, Zenith Bank, your assessment of where they are, how have they navigated through some of the headwinds?
Well, Zenith Bank is the closest commercial bank we have to a proper investment bank, as per se.
Right.
Zenith Bank is currently the cash king in terms of net assets. In the banking spectrum in Tier 1 and all entire banks, it's number one in terms of its shareholders' funds. It's standing at over 400 billion. So it's heavy as a corporate lender. It's a big corporate lender. It is also one of the banks that you see that has a huge treasury balance sheet in terms of the fixed assets. It puts the bonds and treasury bills. So it's one of the lenders that is very risk adverse when it comes to lending to the real sector. But it's a big corporate lender, and its deposit mix is largely skewed towards corporates, because there's even a threshold limit on the account opening for that lender. However, any major big ticket transaction you see in the economy, be it in infrastructure, cement, be it in telecoms, be it in oil and gas, you would always see Zenith playing a large role, either via a syndicated facility or as a standalone facilitator.
Now, by the nature of, I guess, as you talked about, their loan book being geared towards the corporate sector and them generally being risk averse, is that why we see their non-performing loan profile being quite impressive, really? And is that a structural feature of Zenith Bank?
Well, I wouldn't say structural. I would say it's yes, they are risk adverse, and like going back to 2009, when a lot of these banks had very bad loan books and had to sell off most of them to AMCON. Zenith was one of the few lenders, Zenith and GTB, that came off a bit less scarred. So they have a solid risk management framework in place, and also tend to focus on areas that they have the expertise on. Okay. So that's what I think has been their saving grace. Yeah.
And on the other side of the story of the underlying profitability, is this a bank that has reasonable return on equity?
Very reasonable, double digits. It's just trailing the profit king, which is GTB. Yeah. GTB has been able to top banks in terms of return on average equity.
Right. Okay. And now, throwing all of that into the mix and the current dynamic, is this one that you'd be looking at and taking a closer look at from a potential investment perspective?
Definitely. Zenith Bank is a bank, even in the outlook for the year, it's a stock pick we have. Yeah. Although it has traded, it's trading close to its target price. Our target price for Zenith is just around 23 Naira. It is a stock that we see stability in. So it's a stock you want to stake your funds in for the long term, and also in an uncertain market.
Okay. If we cast our eye elsewhere and focus on First Bank, your thoughts on that business? How does it really differ from Zenith?
First Bank, well, First Bank by nature, it's the biggest bank in terms of total assets, over 4 trillion. Yep. As we speak, and rising. The issue First Bank has had in the past 3 to 4 years is its inefficiency. Compared to banks that have asset sizes of maybe 50% of its size, a bank like GTB, I always have to use GTB because that's like the pace setter, yeah. Or even a Zenith, that has an excess of 3 trillion. What returns they are able to bring on assets and even equity make the performance of First Bank really something to look at. However, what we've seen is that there's been a slow transformation, and if recent results are anything to go by, you actually see the possibility of getting ROE of double teens in, say, the next 1 or 2 years. They are still tracking the leaders, which are GTB and Zenith, in terms of overall profitability. However, at its current price, it is a very good bargain for us as a stock poised for growth. It tends to be one of those stocks that can only get better.
Okay. Now, the traditional banking segment of this is quite a big chunk of revenue. Do you see things like asset management, which is, I think, institutionally focused, stuff like that actually growing going forward?
Now, that's tricky. Well, in terms of asset management should grow because there's still a large chunk of the unbanked real sector out there, and I actually foresee further consolidation because the gap between the tier 1 and the lower tier banks are such that it's inevitable that some of the tier 2 banks would need to probably merge or have some kind of combination to be able to compete effectively with the top six banks. The top 6 banks are banks that have assets above 2 trillion. So I do see a lot of room for, like you see, there's a heavy player in that aspect. ETI, it has a development corporation, EDC, who is purely focused on basically managing assets, and they are poised favorably here. However, for banks like the 2 we just mentioned, First Bank, and First Bank is now a holdco, so they actually have an arm that handles that. That's the FBN Capital. That's like the investment banking arm of the group.
Right.
Yeah. So yeah.
Okay.
Slowly, I do think you. Okay.
So taking that
Hello?
all into account, you touched on it a little bit, but this seems like a bargain at these current levels.
Definitely, they do.
Okay, perfect.
Relative valuation to peers, relative valuation to where they've been before, especially a bank like First Bank, is definitely at a bargain. At ₦9 plus, it's a bargain for an investor. Yeah.
Perfect. Let's leave it there. Thank you. Thanks to my guest, Usoro Essien, Head of Research at Greenwich Trust. That's all from Buy Africa this week. Remember to follow me on Twitter. That's @Modiba_Tshepo, and send us your thoughts about the show using the hashtag BuyAfrica. From myself and the team, goodbye.